in one of my books, you had given a quote. In the first edition of the book, Loophole Games, a quote from you also appears.
I know that.
That was back when I was in Bangalore.
Yes, that's remember. Yeah, you correctly pointed out. Yeah. How have you been?
Good. It's been a little hectic of late, but otherwise good.
So Seema, whenever you want to start.
Yeah, Mukesh, sure. We'll just give the audience 1 minute to join in.
Sure.
Sir, has it been hectic closing APS?
And the point of discussing anything from office here,
Okay.
my idea for today was, what I understood is that tax skill comprises of students mostly, either students or those who are preparing for the ADIT examination. So what I thought is I'll take them on a tangent. I'll not discuss anything which I do in my day job, because that's actually pretty boring. What I'll be discussing is some trends that I have observed of late, some trends in international taxation or cross-border taxation, which may become some major issues in the future, which may lead to some major litigation in the future, or which may snowball into something big in the future. How does it sound?
Perfect. That's very good.
I think it sounds excellent. Sir, just for your information, we'll be recording the session.
Yeah.
So that you're aware, and then some clips we play here and there on LinkedIn and on our website.
Yeah, sure. Just make sure that somebody mentions that my views are personal here.
Yeah.
It's on record now. That your views are personal.
Yeah.
I started reading your tangible guide to intangibles. Very interesting.
Thank you.
Mukesh sir had handed me a copy when I had visited him, and then I ended up going straight home, so I could never get it to office. But
wonderful.
Okay, let's start. Mukesh, you want to start with the introduction?
Yes, I can do that. Whenever you give me a cue, I'm ready.
Yeah, I think let's start. It's 4:02, and I think people will keep joining. We should start.
Okay. Good afternoon, everyone. On behalf of Seema and rest of my colleagues at Skilled, I'm indeed delighted, privileged, and honored to welcome my friend Smarak Swain. Mr. Swain works in the Foreign Tax and Tax Research Division of Department of Revenue, Ministry of Finance. He's got very, very wide experience in the area of tax investigation, transfer pricing audits, tax audits for startup entities, and also APAs as well. What is more important is that, to his credit, there are several authorships, particularly the latest one relating to intangibles. It's called Intangible Guide to it's called Tangible Guide to Intangibles, Identification, Valuation, Taxation, and Transfer Pricing. And his other important book, which Mr. Swain reminded me just a while ago, wherein I have been quoted, is on the modus operandi for tax avoidance in India. The book is called Loopholes, a Treatise on Tax Avoidance Strategies. Well, Mr. Swain graduated in electrical engineering from the coveted Indian Institute of Technology, Kharagpur in 2006, and he joined the Indian Revenue Services in 2008. He also holds a Master's in Taxation and Business Law from Nalsar University in Hyderabad. So with that, let me hand it over to you, but just wanted to add one important disclaimer on his behalf. This is a education session for students expressed by everyone, including in particular by government, guest speakers are there. Can everyone keep their voice on mute, please? Chetan Kothari, please. So this essentially are personal views. Just before we started, Mr. Swain shared with us that he's going to share some different kind of experience rather than what he does on a day-to-day basis. So with that, over to you, Smarak ji.
Thank you, Mukesh ji. I'll just share my screen once. Just give me a moment. Thank you. Mukesh ji, Seema madam, first of all, thank you for calling me here. And I always like to interact with, with youngsters, especially young, young professionals who are preparing for either the CA exam or for any master's examination. And I feel that it is a privilege for me to be here. Now, as Mukesh ji introduced, I work in the foreign tax and taxation division. But what I thought for today is, let me not go into the complex matters, some complex matters of transfer pricing or APA map. Those are things that you keep hearing on a daily basis, and I'm sure those are things which on which a lot of concepts keep flying here and there. I also don't want to speak about about things that are happening in maybe the UN or the OECD or the World Bank on bigger tax policy issues. What I'll be discussing about are some very disparate issues, small issues, which I feel are going to snowball into some major issues in the future. So now, why I want to discuss these issues is because my day job, I feel that my day job is something which is very boring. Okay, there's nothing much to share about those days, about what I do in my day job. What I do in the weekends is I look into trends in taxation, trends in tax administration, trends in tax investigation, and I like to do that, and I see that a lot of features keep coming up. Like for example, what about artificial intelligence? How do you tax artificial intelligence? How do you can you give a PAN number to a bot, to a robot? So this kind of things I keep I keep reading, and I try to understand what trends are coming up. Of course, AI has not become that big or that autonomous so as to mandate the requirement for taxing the AI as of now. So I'll be discussing some very mundane issues. They're quite disparate issues, but please stay with me. And what I'll be doing is I'll be just raising the issue. I'm not giving any solution per se, because these are new issues which are coming up. These are issues on which still probably there is a clarity has to come, or some proper case laws have to come in the future. What we can do is I can raise these issues, and then you can give your opinion about them. What you think should happen in these cases, or what do you think is a way forward to reduce litigation or to diffuse the situations if this snowball in the future. So yeah. So this is a question that I'm asking you. Ki, what tax problems will we be facing in the coming years, and some of the problems that I'll be discussing here. Maybe I won't be able to discuss all the problems here, but some of them I'll be discussing here. I'll directly dive down into the first topic, that is on remote work. Now, what we have seen of late is because of COVID-19, and also before COVID-19 started, even before COVID-19 started, a lot of work was being outsourced by companies in the developed countries to developing countries. Now that is not something new. Even if you look at the IT and ITA sector, these are M&E groups which have cost centers in developing countries, and the cost centers in the developing countries are basically making use of local talent, which probably comes cheap. But the trend that we have been seeing since 2015, when cloud computing actually took a big boom, was that you appoint consultants from around the world. You just you put up a classified on LinkedIn, or you give a notice on LinkedIn that you want to hire some people for a job, and the hire has to be and the person and the consultant has to work remotely, or the retainer has to work remotely, and then you get applications from all over the world, and you can hire anyone from anywhere. Even if you're an SME company based in, even if you're a small or medium enterprise in Europe, or if you're a S corp in the US, you can hire anyone online and you can start working with them. So that started happening in 2015, but that did not pick up before the COVID-19. After COVID-19, many companies were also forced to work with the employees remotely, and a lot of disruption happened. around that time, McKinsey came up with a report that said that a lot of work can happen remotely without losing productivity. Now that means that an internationalization of the market for skilled labor is happening, and that is happening under our nose. As we are speaking on a daily basis, a lot of people from developing countries probably are getting hired as retainers, as consultants for companies in the developed countries. Now there's some little bit of problem in this. The problem that arises is because of the tax treaties and the variability in tax treaties. If you look at the tax treaties, especially if you look at the tax treaties of India, you'll see that there are two provisions which may get attracted. One is Article 12A and the other is Article 14. Now, Article 12A is about fee for technical services. Let's say there's a company in Sweden which has hired a consultant or a software engineer in India. So when the payment is being made by the company probably has to withdraw, has to withhold some taxes. So fee for technical. So Article 12A says that the taxation rights is partly with the residence country and partly with the source country. But there's another article, Article 14, which says that for independent personal services, which is basically the services that consultants offer, the taxability is with the country of residence. Now we see an anomaly between Article 12 and Article 14. Logically speaking, there should be a hierarchy between Article 12 and Article 14. Like, for example, Article 12 will mention that this article will be applicable to everyone except those who come under Article 14. Or Article 14 will mention that this article will apply to everyone who comes here except Article 12A. Now, if you look at the UN Model Treaty, now in the OECD Treaty, you won't find Article 12A. But if you look at the UN Model Treaty, what you will find is that there is a clear-cut hierarchy. Article 14 applies to those cases where Article 14 applies, Article 12A does not apply. Okay. So if Article 14 applies, then Article 12 will not apply to those cases. Now, but the interesting thing is that is mentioned in the Model Treaty. If you look at the India-Japan Treaty, which came into force in 1989, I have quoted the treaty here. Okay. If you look at Article 12, it mentions that the term fee for technical services as used in this article means payments of any amount to any person other than payments to an employee of a person making payments and to any individual for independent personal services referred to in Article 14. So, so I think I got a little confused. So India-Japan Treaty maintains a hierarchy in which Article 14 comes at the top of the hierarchy and Article 12A comes after that. So if both Article 12A and Article 14 get triggered, then actually Article 14 will prevail over Article 12A. And so the remote worker in India will be taxable in India, he will not be taxable in Japan, right? Okay. Now, but in the UN model, what happens is Article 12A has precedence over Article 14 in the UN model. In the UN model, what is mentioned is that Article 14 will apply except in those cases where Article 12A applies. So, and then what I did is I went and looked at a few articles, few treaties. I found some degree of ambiguity in India's tax treaty with Germany and India's tax treaty with US. There may be other tax treaties also, in which this ambiguity may remain. But in the case of India's tax treaty with Germany and India's tax treaty with US, I could not find a clear-cut hierarchy between these two articles. Now, what happens when this happens? When something like this happens? If you're working, if a tax treaty is getting invoked, in which both the treaty partners partners may interpret differently, what will happen is the tax authorities in, let's say, Germany, let's say the company is in Germany and the remote worker is in Bangladesh. So the tax authorities in Germany, they will invoke 12A. Why? Because withholding tax, because they're getting some source taxation rights there. Whereas the tax authorities in Bangladesh, they will invoke Article 14. Why? Because they will think that Article 14 is more beneficial to them than Article 12A, because Article 14 talks about residence country taxation. So this kind of so this actually will lead to a lot of cases of double taxation, unfortunately, which may hit consultants, big consultants or small consultants. Consultants on a real-time basis are going to face this problem. Even during the COVID pandemic, when some consultants shifted from a few developed countries to India temporarily, they also face this kind of issues. In the long run, this is going to become a major, this may become a major issue between source countries and residence countries. Source countries are going to invoke 12A and residence countries are going to invoke Article 14. Another interesting, what do you say, how do I say that? Another interesting anecdote about this is that traditionally developing countries have always preferred source taxation and developed countries have always preferred residence taxation. But in the case of remote work, we are seeing a situation in which developing countries benefit from residence taxation and developed countries benefit from source taxation. I hope I'm making some sense here. Okay. So what can be a possible solution for that? So when a consultant, let's say, works for an American company and the consultant is based in Bangladesh, it receives a payment from a company in the US. The company will always try to play safe. So the company will deduct a withholding tax of, let's say, 10% or 15%, whatever is mentioned in the treaty, and then the money will come to the consultant in Bangladesh. The consultant in Bangladesh has to pay full taxes in Bangladesh under Article 14, and also it has paid 15% or 10% under Article 12A in the US. That leads to double taxation. So the consultant may may go for MAP, but again, MAP is something which is not a very regular, which is not very regular. Ultimately, the consultant is going to challenge the Bangladeshi tax authorities interpretation and tell them that, look, 12A will apply. Now, this kind of situation will not arise in those tax treaties where 12A where 12A and 14 have been harmoniously defined. But in those tax treaties where they have not been harmoniously defined, there is definitely going to be some kind of friction, if I may say so. At this point, if anyone has any doubt or if anyone wants to discuss anything or raise any point.
Spark sir, so you mentioned that in a few tax treaties there may be harmonious Article 12A and 14. Are there any examples where they've given harmonious
Yes.
interpretation?
Like for example, in those treaties that directly follow the UN model, or those treaties, or for example, in the India's case, for example, India-Japan treaty. India-Japan treaty is very, very clear about the hierarchy between the services, and there are many other treaties of India, especially those treaties which have happened after 2017. Consistently in all those treaties, there is a hierarchy. It's clearly mentioned that 12A will, I mean, when Article 14 applies, then 12A will not apply. But if you go to some treaties which are before this period, like as I mentioned, German treaty or the US treaty, there is some ambiguity that remains here. Okay. So the next one I have mentioned. Okay, so on the next issue, I have mentioned something in great detail, but I don't think we need to discuss that in so much of detail. I can just go through that very briefly. Now, what will happen if you are a SME? If you are an M&E group, and I'm presuming that you have cost centers in many countries in the world. So if you want to hire an employee, you will not directly hire the employee. Your subsidiary in, let's say, Bangladesh will hire the employee, or your subsidiary in Sri Lanka will hire the employee. But what happens if you're an SME and you want to hire some employees? So that is the second issue. Before I go to the second issue, I just wanted to go back to the first issue and give another anecdote. Well, what happens if you remotely work for a company in the US, let's say, okay, and what you do is you take a flight, you are in India, you take a flight to Nepal, you get your passport stamped, and from Nepal, you come by the land route to India. So, I mean, which is your country of residence? Because you are taxable in your country of residence, right? So there's another ambiguity that comes up there, whether you're taxable in India or Nepal. So of course, that is a very abusive practice, if I may say so, if that is possible. So coming back here, so what happens if you hire someone as an employee? You're an SME, or you're a startup working in the US, in Silicon Valley, and you have had a couple of employees to work from India. What happens in that case if you're an employee? Actually, nothing happens. The taxation is clearly mentioned in Article 15 of UN model, and the equivalent you will find in most of the real life tax treaties, that is on dependent personal services. It is pretty clear in most of the treaties that the employees gets taxed in the country in which the employee is a resident. So if you are staying in India and working for an American startup, then your taxation is in India. There's no ambiguity at all in that. Now the problem that arises is in service PE. Okay, so now this concept of service PE does not exist in the OECD model, but it does exist in the UN model and in many practical tax treaties between developed countries and between developed and developing countries also. You will find a service PE clause. So for example, if you go to India-US tax treaty, there's a mention of service PE clause. It says that if you are staying in a, if you have an employee, if you're an American company and if you have an employee staying in India for more than 90 days in a 12 months period, and the company is providing services through that employee, then tax authorities can always say that the American company has a PE in India. Service PE in India. Now that is something which may deter companies from hiring employees. And the general modus operandi in remote work is you don't hire employees, you hire consultants. But what if you are doing some very sensitive work? And what if you want to have an employer-employee relationship or a master-servant relationship with that person? Or what if you have some employees who are footloose, who are moving around the world, and due to some reason they have to park themselves in India for a long period of time? In that kind of situations, a service PE issue does arise, and that is a major constraint. I believe that is a major constraint in small enterprises or startups in other countries from hiring employees in India. As and when the job market gets internationalized, probably some rethink on this in the domestic tax policy will come, or some carve out for this will come in the domestic tax policies. That is my guess. Now coming to a completely different issue. So I'm toggling around from one issue to another issue. So coming to another issue, I found this pretty interesting. I found this is pretty interesting. So if you look at the Akhilesh Ranjan Committee report on digital taxation of 2015 or 2016, I believe 2015. So that report, I think some key management personnel of Flipkart were also part of the committee. It was a very lengthy, it was a huge committee, and they had very lengthy deliberations. That committee, was very fixated about the concept of nexus. That digital companies do not have territorial nexus in India. That's the reason why their routine profits cannot be taxed in India. So, but anyways, the debate over digital taxation has moved, in many directions. But if you just go back to that 2015 document, in which that committee concluded that because digital companies may not have, territorial nexus with India, they may not be paying any routine. They may not be paying taxes on any routine profit in India. They may not be booking any routine profits in India. So how do you solve that? They had explored a lot of options. Some options were coming from Action Plan 1 of BEPS 2015 also, and but one angle that they missed out probably was the angle of data localization. Now, data localization is something which is completely unrelated to taxation, but there can be huge tax impact of data localization per se. Now, data localization rules, some kind of draft data localization rules have been made, but they have still not been passed by the parliament. Data localization is happening in different sectors in piecemeal manners. For example, RBI is going for data localization of payment gateways. And probably for social media, the MeitY, the Ministry of the Ministry of Electronics and Information Technology, they are planning some regulations in India, unlike in the Europe. In Europe, we have GDPR, which is a very comprehensive rule on data localization. In India, data localization is not happening in one go. It is happening in a step process. So what will happen when ultimately data localization happens? When ultimately data localization happens, probably some new models or new structures will arise. Unless that arises, a major challenge, the M&E, digital M&Es are going to face a major challenge. Why are they going to face a major challenge? Because a typical model, I'm not taking the name of any company, just saying that in a typical model, there's an analytics center in California. There's an entrepreneur in Ireland which takes all the risk and probably which holds the IP. Or if the IP is with California, then it has a cost contribution. It has some kind of an arrangement. It has a CCA or it has some kind of an arrangement by which it is managing the IP. So the Irish company is managing the IP. It is also the entrepreneur. It is taking all the risk, and the market is in India, let's say. Or let's say the market is in Bangladesh and the users are in Bangladesh. So Bangladeshi users, whatever, howsoever they access the website, the portal or whatever they access, whatever data about their behavior is being collected, that data is being collected by Ireland because the company is based in Ireland, the website is owned by Ireland, and that is also the legal owner of technically it doesn't own the data, but once the data has been generated and it has been partly processed, then the processed data is an intangible asset which is owned by the Irish company. Data processing takes place in California. So that is probably a very simple value chain. And after the data processing happens, probably that data can be utilized for some purpose. So that data may be sold, or that data may be used to sold some services to consumers in consumer markets. Now, consumer market may be in India, or consumer market may be outside India also. So that is generally the structure. But in data localization, what happens is the government makes it mandatory for you to localize your data within the country. So let's say you are keeping all your data, you're dumping all your data in Amazon Web Services, AWS, and AWS has 2 servers in Mumbai, 1 server in Shanghai, 1 server in Cayman, 2 servers in Paris, and a few servers in the US. Usually what happens is this data when it is stored in the cloud media, it is being it's a virtualized data, which means that the data can be stored at any point of time in Bombay or in Shanghai or in Paris, depending on the efficiency and depending on where spare capacity is. If data localization comes in India, full-fledged data localization comes in India, the data that is being generated from users in India cannot be moved outside the country. That data has to be necessarily stored in Mumbai, in the servers in Mumbai, and from the servers in Mumbai, probably they can. As the rules stand today, they cannot be even accessed by your sister concerns outside the country. So if you have to store that data in India, in Mumbai, and if you have to process that data also in India, you necessarily need an office in India, or you will definitely need an office in India. And given the stringent rules, given the very detailed rules that have been framed in the initial draft of data localization, you will also need a couple of employees in India for meeting the compliance burden also. In this context, something I'm reminded of one article that came very recently in 2021. I think August 2021 it came. It was on Twitter. Some new IT rules had come. Even I'm not sure about those rules. Maybe anyone here who knows about the rules can share with us what exactly those rules were. Some new information technology rules had come on Twitter, on social media. The rules basically pertain to something on what do you call censorship. It pertains to censorship. So, but that is beyond the point here. So Twitter had to meet all those challenges, all those compliance. Twitter had to meet the compliance burden. But in this article, as you can see, Twitter was unable to meet the compliance burden because Twitter said that if they send an employee, if they appoint a public officer in India to meet the compliance burden, then technically Twitter has a permanent establishment in India. And so Twitter has to pay taxes on its routine profits in India as well. So this is something which may become something big in the future. Maybe in a couple of years, data localization will be applicable to most of the sectors, most of the business segments. At that point of time, tax practitioners are going to get some new kind of challenges. They're going to face some new kind of challenges because of this. That's what I believe. Anyone can share anything interesting about this? Or anyone who has an idea about GDPR? What has been the impact of GDPR on digital companies? I also wanted to know about the American firewall, the Great Firewall of China. Not American, sorry. I also wanted to know about the Great Firewall of China because it's called the Great Firewall of China, but it's actually a kind of firewall which stops cross-border movement of data, or which makes cross-border movement of data very difficult. That is akin to data localization, which came in China back in 1990s. Anyone has any idea or opinion about taxation issues? I see some message here. Yes, Vivo, please tell me.
Hello, sir. It's an honor to attend this lecture. Am I audible?
Yes, Vivo, you're audible.
Is it plausible to say that a compliance office of Twitter in India is merely a compliance office? It has no substance. It is not carrying out any business from India and wouldn't attract the permanent establishment clause.
Yes, Vibhu, you have raised. I mean, you have made a good point. You have made a good point because for a permanent establishment to operate, it has to provide services through the permanent establishment, unless there is a force of attraction clause in the tax treaty. So in the tax treaty, if there is a force of attraction clause, then even if you have a compliance officer posted in India, if you're doing any other activity which the compliance officer is not involved in, then also that can get taxed in India if there's a force of attraction. But most tax treaties do not have a force of attraction clause in India. So if there's no force of attraction clause in India, technically, whatever the compliance officer does, whatever services the compliance officer offers, only those services can be brought within the ambit of the PE in India. But I hope you understand that the compliance officer still constitutes a PE. So there will be some kind of a compliance burden because the company Twitter has to take a pan. It has to do some small, some minor compliance. It has to take up. Secondly, the taxmen are not going to stay at that. I mean, I'm not saying that they're not going to stay at that. They may not stay at that. Okay, the taxmen may start asking questions. Second layer of questions. The compliance officer, what exactly is the compliance officer doing? The compliance officer is enabling Twitter to operate its business in India. So whatever services Twitter is providing to its customers, indirectly it is a compliance officer who is facilitating all of that. Did you get my point, Vivu?
Yes, just a follow up, if I may ask. The compliance officer is merely enabling Twitter India to operate its business. It's just a legal compliance, and
Yes.
no core activities of Twitter are being performed through that compliance office. They might fall into the exception of auxiliary services or auxiliary activities being carried out in India.
Yes, Vivo. In fact, if you ask my personal opinion, I also think something very similarly. But what I'm telling you is that this can be a flashpoint for litigation. Okay.
Yes, sir. I get
this can be a flashpoint for litigation. I'm not saying that this will be a flashpoint for litigation.
yes, sir, I understand.
Yeah. Okay.
Thank you so much.
Thank you. But the point is well taken. This is actually, I personally believe, this is my personal opinion, that yes, this is actually an auxiliary service that is being offered in India. Mukeshji, what is your opinion on this?
Well, I would like to believe that this is an auxiliary service, but I would say that you will need to look at the terms of the treaty, as well as you will need to do a reality. And the reality check will depend on what kind of evidence is there on record. So you will have to go beyond the legal agreement about what is written as to the role and responsibility of the compliance officer. But if the compliance officer is seen as performing anything which is close to a core function, and then it may not be preparatory enough. Otherwise, it would be.
I want to say something. I have a different view. I feel it will be core to the operations of Twitter in India, and it will be debatable. I mean, the good view is that it is auxiliary, but it will actually be core to the operations, right? Twitter will not be able to operate without that in India.
And Seema, if that is the case, then the most practical advice that you can give to a client is attribute some profits and pay some taxes.
Yeah.
Correct. And so really the value in the processing, the technology processing value is what will be of paramount importance, because that technology will still be owned overseas, and then it will only be fair that the consideration that goes out for it is significant, to say the least.
Smarakji, I don't know if this is the right time to ask the question, but as a practitioner, I feel that the larger concern on PE related exposure is not that of PE, but it's that of attribution of profits.
Yeah.
One of the things that is very anxiously awaited is the guidance on profit attribution. So let's take a case of this, let's go with what's Seema is saying, that this is a core function, there is a PE. Now, in my view, very minuscule profits should be attributed. But what does minuscule mean? How do you measure it? What kind of arm's length principle do you apply? Those are some of the that come.
Thank you very much. In fact, on PE profit attribution, I believe there's one position which is which some may find an outlier, but which I have found many people voice it. What they say is that the moment you have a PE in India, the moment under Article 7 there's a PE in India, so that company becomes a resident in India. So its entire its entire business income from India gets taxable in India, and it becomes a domestic matter. The expenses which have to be the expenses which can be booked against the income, that also has to be looked into under Indian domestic law. There's some people who in fact have that opinion. Of course, there are others who say that if there's a P in India, that branch has to be taken as has to be treated as a separate entity, and then a profit attribution has to be done at arm's length using transfer pricing principles. So on profit attribution, there are very divergent views, and I think this is not the forum to go into that. That's pretty complex, and that can go on for hours. So I'll come to the next issue. Yeah. So I'll come to the next issue. So this one is section 194O. I don't know hyphen O, that is just O, 194O. So that section came in 2020. It says that any e-commerce, any platform, they have not mentioned platform in the law. I'll just colloquially say platform. So if there's any online platform which is providing service to someone in India, or which is selling any goods to someone in India, then on whatever money, then it has to deduct some TDS while facilitating that kind of service or sale of goods. Now the understanding there is that this kind of a platform is basically a two-sided market, okay, because there are two different people operating on this market. and this platform is basically providing a facilitative service. And there's another assumption here, that whenever the buyer and seller are interacting, whenever the buyer is making the payment to the seller, that payment is going to the e-commerce operator. Otherwise, how can the e-commerce operator deduct TDS? Okay, so there is an assumption here that that whenever the buyer is purchasing from the seller, the payment is also going through the platform. So that's the reason why the platform has to deduct TDS. Now, why did I raise this section is because this section puts some compliance burden on non-resident companies, on non-resident platforms. Now, how do you enforce that? Let's say there's a non-resident platform which is violating some of the terms of this section. So you cannot just go and do a survey. You cannot do a TDS survey on that. So what you basically do is you are completely reliant on the non-resident platform becoming compliant to this section. As of now, that is the situation, that you do not actually have any enforcement power over non-resident platforms. And that is true not only of section 194O, probably that is also true of OIDA services, GST and OIDAR. Hello? Did anyone say anything?
Yeah. May I request everyone to keep their volumes on mute, please? Thank you. Please go ahead.
Yeah. So GST and OIDA services, that is also, kind of a pestering kind of an issue, because the liability of the paying GST is with the non-resident service provider, and enforcement of such rules enforcement of such rules or such regulations have not been clearly mentioned. Of course, enforcement can easily happen. We have the Information Technology Act, we have the MeitY enforcement. This is how you enforce it. If you don't pay the taxes, then you just inform MeitY to block that website or to block that platform from operating in India. It is as simple as that. But how do you get to know that whether that platform is eligible to file GST for OIDA, and if it is eligible to file GST for OIDA, how much of GST it has to pay, and how much of services it has actually provided. So those details are actually not available with tax authorities in India, and we do not foresee any straightforward way of getting that information unless you use the exchange of information clauses in the tax treaties. Now, practically speaking, what is happening is there are some forex trading companies based in Hong Kong, based in Mauritius, which are allowing Indians to trade in forex. Now India is a very regulated market, so Indians can trade in only those forex using those forex traders who have been approved by the RBI. Now there are only a handful of such forex traders who have been approved by RBI. Unfortunately, common man in India is doing a lot of trading in forex using some offshore platforms, using platforms in Hong Kong, using platforms in Mauritius. Now they are on the borderline of being legal and illegal. We don't know whether they're legal or illegal. Now those forex platforms, do you think they are going to file the return of income they're going to file the TDS return in India? Do you think they're going to deduct TDS when engaging in this kind of transactions? And what do you think is the way forward for things like section 194O or for OIDA services? I feel that this is a very pestering matter because we do not have much of an enforcement power over them. But then again, others have any idea, or others can say anything on this? Well, this can be food for thought for everyone here. I've been grappling with this issue for a few days now, not long, but I will look into it. I'll try to see what can be done. Theoretically, exchange of information protocol works. Theoretically, there's an automatic exchange of information protocol, a very good automatic exchange of information protocol between India and its treaty partners. But this is something very, very typical, and this kind of information usually doesn't come through that. So so probably some kind of an international solution has to come for this. And it is not just forex trading companies. A lot of Ponzi schemes are also operating. they seek investment from India. A very famous one is MMM. So I'm not expecting Ponzi schemes to file TDS return. No, I'm not expecting that. I'm just saying that many such things are operating in the Indian market from overseas, and they are not meeting some of the compliance requirements in India. They're not meeting legal requirements in India as well as the TDS compliance requirements in India. Since they're not meeting the legal compliance requirements of India, there's no way they're going to meet the TDS compliance requirements. Okay, so if I come to the next issue, that is on cryptocurrencies. Now, cryptocurrency is not an international tax issue; it is a domestic tax issue, frankly speaking. But it can at times become an international tax issue, and there has been a lot of debate on cryptocurrencies in international forums, probably because no country is sure about how to deal with cryptocurrencies. So now, what happens when you when you have a lot of cryptocurrencies, or you have made some cryptocurrencies, or you have made some money by using cryptocurrencies, and you want to file a return of income? How do you treat the cryptocurrency? So broadly speaking, there are only three ways by which in which you can treat the cryptocurrencies. Income Tax Act in India is pretty silent about it. I'll tell you what happens in the US. There are three ways. One is you can treat them as an intangible asset. Secondly, you can treat it as securities, or thirdly, you can treat it as foreign currency. And whether you treat it as an asset or securities or foreign currencies, it depends on the facts of the case. Okay, you cannot use a single bracket or a single characterization for each and every cryptocurrency, because different cryptocurrencies are very, very different types. So what happened in the US is they made a mistake initially. They said that all cryptocurrencies are basically intangible property. They came up with a notification saying that all cryptocurrencies will be treated as intangible assets and intangible property, and they will be taxed the way intangible property is taxed. But later what happened, the SEC, the Securities and Exchange Commission in the US, SEC realized that a lot of cryptocurrencies are actually not cryptocurrencies. They're being used to raise money from the market in the name of ICO, initial coin offering. So when you're raising money from the market, you are basically a securities. You're basically using a securities instrument, because when you raise money from the market, you have to do it either through the IPO route or through the collective investment schemes route. In India, there are two routes. One is the IPO route, and one is the CIS route, collective investment schemes. Other than that, you cannot actually solicit investment from public. And the SEC found out in the US that there are a lot of cryptocurrencies which promised huge returns to investors, and based on that, they characterized some cryptocurrencies as securities also. So when SEC characterized some of them as securities, naturally the US IRS also became a little inclined to characterize them as securities. Then recently, what happened? In one case, one taxpayer in the US went to court. I think it was the district court of Miami, saying that I have earned this much amount of cryptocurrencies and I have paid the capital gains tax on that. Okay, so I need a refund, and please get me a refund. So in the court, the Department of Treasury of US has said that no, in every situation we cannot call cryptocurrency as intangible asset. In some situations, it has to be treated as foreign currency also. Okay, so that is a new stand taken by the US government. So within the same US government, US IRS has a very clear stand from quite some time. Then SEC has another stand, and now the US Treasury, which controls US IRS, that also has a third stand. It is now to be seen what happens in the US. In India, we are still not sure whether cryptocurrency is legal or illegal. Of course, the Supreme Court has said that it is not illegal now, and so now you can trade in cryptocurrencies very much. But we're still not very clear about the legality. So taxation is something which is not in the front process, which is not in the which is not even under discussion now. The tax issues. So very shortly, I'll discuss some of the tax issues. But before I go into that, I wanted to ask you something. Those who are experts of GST here, or those who have dealt with GST, do you think if I give you cryptocurrency, if I give you any cryptocurrency, then I have to collect GST also from you at 18%. Will a supply of cryptocurrency from me to you attract GST? What is your opinion on this?
It will depend whether this is a rendition of service, because if it's a rendition of service, then the answer is yes. Sorry, I'm giving you a very theoretical answer.
Well, that was my point also, and I mean anyone else who can say something. Now I'll tell you. After that, I'll tell you what my wife thinks. She's a GST master trainer, so and I don't know much about GST, so I'll tell you what my wife thinks on this. But anyone else has any view on this? Well, okay. So what my wife says is that GST is not a tax on goods. GST is not a tax on services. GST is a tax on supply. Now, anything that has been supplied, which does not find a mention in the negative list, will be taxed under GST. Now, that is something very frightening, and I don't know where she comes from, but this is what she says. She says GST is not a tax on goods. It is not a tax on services. It is a tax on supply. So, if anything has been supplied and that thing or that whatever does not find a mention in a negative list, that these guys have prepared, then there'll be a GST on that. And there is specific provision in the IGST law that says that talks about transfer of intangible assets. It says that transfer of intangible assets, supply of intangible assets is going to attract a GST of 18%, 18%. Now I wonder what kind of compliance the cryptocurrency exchanges are having. I don't know. I seriously don't know what kind of compliances they are meeting. Even the GST office is not raising any queries, probably because it looks very absurd. It looks very absurd that some kind of an asset you are trading on the cryptocurrency platform and you have to pay GST on that. That I don't know. I don't know how that is going to be taken in the future. So I'll just park that issue by just sharing what the opinion from the GST side is. Now coming to the income tax issues, if GST, if cryptocurrency is considered an asset, then any sale or purchase of cryptocurrency will lead to a transfer, and it will ultimately lead to a capital gain. But there are some situations in which capital gain will not arise. Like for example, if there is an airdrop or there is a hard fork. Now section 55(2) says that, section 55 subsection 2, it says that if there is any intangible asset, some assets have been mentioned in that section, which have been internally generated, then the cost of acquisition has to be taken as nil. If the cost of acquisition cannot be determined, then whatever money you get is actually capital receipt, which is not a capital gain. I hope you are able to get the difference. If I'm getting some money by selling an asset, that is a capital receipt. After I get the capital receipt, minus the cost of acquisition gives me the capital gains. But if the cost of acquisition is not determinable, then it is only a capital receipt, and capital receipt is not taxable under Income Tax Act. The general idea of Income Tax Act is that every revenue receipt is taxable except otherwise stated. Every capital receipt is exempt except otherwise stated. So if there is a capital receipt, it is not taxable. So if I'm getting anything, any cryptocurrency from an airdrop or hard fork or by mining, okay, technically the income that I'm getting is a capital receipt, so, and it is not taxable. In the case of mining, maybe I can, maybe the taxman can tell me that you're doing a business. You're into the business of mining if I'm doing it on a regular basis. But in the case of airdrop or hard fork, it is clearly a capital receipt till the time section 55 subsection 2 is amended to include cryptocurrency or digital assets or virtual assets within the definition of those intangibles in 55(2). Now coming to the idea of cryptocurrency as a currency, cryptocurrency as a foreign currency. See, because the Income Tax Act is not very clear, and no special provision has been made for cryptocurrencies till now in the Income Tax Act. The assessing officers are actually assessing officers actually have a lot of discretion in interpreting cryptocurrencies. They can interpret it as an asset also, or as a currency also. So what are the advantages or disadvantages of interpreting CC as a currency? If it is interpreted as a foreign currency, the strongest point that can, the biggest benefit to the revenue is that the revenue can use the mark to market method. So let's say there's a kid who earned some 10 cryptocurrencies 10 bitcoins back in 2014. So those 10 bitcoins on today's date are worth maybe 50 crore rupees. Okay. But unfortunately, because he's only holding on to that Bitcoin and he's not selling the Bitcoin, income tax department cannot, cannot impute any income and tax it. Okay. But in case a cryptocurrency is considered a foreign exchange, in that case, that kid has to use a mark-to-market method on the last date of every financial year. That is on every March 31, the kid has to look at the market price of Bitcoin, and then he has to again re-evaluate the value of his Bitcoins. That will lead to either a forex gain or a forex loss. And because the value of Bitcoin has been steadily rising every year, it will actually lead to a foreign exchange gain. So that is something that anyone may think about, and AO may think about, and you may also think about. That is also something as a practitioner you may also think about, that yes, if we on principles, if we consider it as a foreign currency, then every year there'll be some forex gain or loss, and on that we have to pay some taxes. But there's another issue here which I don't know how many people are aware of. I personally think that section 269 ST will be applicable in this case. If a taxpayer himself characterizes cryptocurrency as a foreign currency, okay, there's another section which will get applicable, and is a very dangerous section. That is section 269 ST. 269 ST had come about probably to discourage cash payments. Okay, but the language, if you look at the language of 269 ST, it says that no person shall receive an amount of 2 lakh rupees or more otherwise than by an account payee check or an account payee bank draft or use of electronic clearing system through a bank account or through such other electronic mode as may be prescribed. Now, cryptocurrency exchanges, cryptocurrency wallets, they do not qualify as bank. So anything that you get in your cryptocurrency in your wallet from an exchange, that may be a money received by means other than what is mentioned here, which means that you are in violation of section 269 ST. And if you are in violation of 269 ST, you have to pay a penalty of equal amount or equivalent amount. Why I'm telling this is because cryptocurrency is something new. It will take some time for the world to cope with what it is and to make specific provisions for cryptocurrencies. Till that time, whatever is the existing law, that will be applied on cryptocurrencies. And it makes sense for us probably to be sensitized about this kind of things. Yes.
So if we go back to the definition of currency,
yes.
The only place that we are really saying where crypto could fall is or such other similar instruments. I mean, just logically using common sense, it seems more like an asset than an instrument, doesn't it?
Yes. No. Again, that is a borderline area. It does look more like an asset than a currency, but it also looks as it also looks like a currency at times.
It's not an instrument. So I mean to say, the only place in the definition of currency it will fall is or such other similar instrument. So even without going into the test of similar, if we were just to analyze instrument, it seems, to me, it seems a bit of a stretch to call it an instrument.
True. But you look at this thing, bills of exchange. So let's say I use a Bitcoin to purchase something on the darknet today. So does it work as a bill of exchange? If I purchase, let's say drugs on the dark net using bitcoins, using 0.01 Bitcoin, let's say, and someone is actually selling it to me by taking Bitcoin from me.
Hmm.
So it is actually operating like a bill of exchange, probably.
And so then bill of exchange and all is defined, no, in the Negotiable Instruments Act.
It is defined. Okay. So what I mean to say is that it is an instrument similar to a bill of exchange.
Yeah, but it is not a bill of exchange. And so that is why the only place you will come back is to say that the test is really, first, is it an instrument? And then secondly, is it a similar instrument?
Yes.
Okay.
Here my opinion is that we have to keep an open mind, because I also feel that it is more of an intangible asset, but it also plays the role of an instrument at times, an instrument or a medium of exchange at times. So when it plays the role of a medium of exchange, it may be construed as an instrument similar to a bill of exchange. So that's the game, right? I mean, it can be characterized as an asset also. Generally it will be characterized as an asset, but there is a chance that it will be characterized as a currency. And if it is characterized by the taxpayer himself as a currency, then there are some really tricky issues.
Yeah, absolutely. I agree.
And thirdly, they can also, there's some cryptocurrencies, okay, not all cryptocurrencies. For example, if you take the case of a cryptocurrency called OneCoin. So OneCoin will never fall under the definition of currency. It will fall under the definition of asset. Why? Because OneCoin was never transacted on the, was never used as a medium of exchange. But Bitcoin, Ethereum, they have been regularly used as medium of exchange. Okay, or take the case of Dogecoin, Dogecoin. So if you want to pay, if you want to purchase, let's say, contraband or drugs on the dark net using Dogecoin, I think it's called Dogecoin. Okay, if you want to pay by Dogecoin, the other party will say, no, I don't want Dogecoin. You give me Bitcoin, which means that not every cryptocurrency can be characterized as a currency as well. It is only Bitcoin, Ethereum, and Ripple which can be characterized as currency.
But it also says as may be notified by the Reserve Bank. So even if it were a similar instrumental, such time as the Reserve Bank does not notify it, it will not fall here.
Yes. So here there is another definition in the second paragraph. If you look at it, Indian currency has been defined. Indian currency has been defined, and after Indian currency, there is something called foreign currency. So foreign currency says that it is any currency other than an Indian currency.
Yeah, but when you go back to the definition of currency.
Yeah. As notified by the Reserve Bank, true.
Yeah.
And I cannot directly fix it within bills of exchange also.
Correct.
Tell me something else. Bitcoin, can we call it a currency note?
No, I mean, as long till the Reserve Bank does not notify it, I want to be very confident in saying it's not currency.
So I'm guessing that my interpretation on this is wrong on FEMA. In the US, already in one case, the Treasury has recognized that the Treasury has been alleging that specific cryptocurrency was currency, foreign currency. They have characterized. So in India, I was very eager to pull in something by which I can say that it is currency. So I looked into FEMA law, because currency is not defined in income tax law. But as you are you're very correct, it has to be notified by the RBI. Now that has not happened. RBI has not notified virtual currencies as currencies per se, and currency notes always means physical currency notes. True.
Okay, sir. Please continue.
Yeah, I'll continue. I think I'm overshooting my time. Okay, no, not an issue, because I think this is the last slide that I'll be discussing. That is cryptocurrencies as securities. What happened is that the SEC found out in a couple of cases. One was RE coin. One case was called RE coin versus SEC. You can Google for it. And there were a couple of other cases in which SEC found out that the founder of the currency went to the public at large, people at large, and told them, please invest in this cryptocurrency. You will be getting a return from what we make. So if you invest in the cryptocurrency, whatever investment you make, that will be taking note of, and will be using all of that investment to run a business, to run an online business on Ripple. on Ethereum platform or on Ripple, and we'll also be doing some kind of trading. Whatever money we'll be getting, a portion of the returns will be giving it to you. So which means that they were raising money for in the name of issuing cryptocurrencies. So SEC said that these companies, they're issuing initial coin offerings. Whenever they issue initial coin offerings, they have to take a permission from SEC. Similarly, in India, if you are issuing an ICO, you have to take permission of SEBI. Technically speaking, you'll have to take permission from SEBI. But what I got to know recently, very recently, is the couple of platforms, WazirX and a couple of other platforms, which successfully released ICOs of a few coins without taking any approval from SEBI. Till now in India, no action has happened. I mean, SEBI has not taken any action, probably because if you look at the exact law in exact SEBI law, probably ICO doesn't fall within that. I don't know, but SEC has gone into the substance of the matter. SEC has put substance over form and said that ICOs are nothing but securities. And so if you're raising money from the market in the name, in the name, then you have to characterize it as securities. So if it is characterized as a security, then the taxation will again, be a bit different. So I'm reaching the end. I wanted to discuss this a little bit, but I don't think that it needs to be discussed much. On externalization, this is something that was happening very rampantly till now. But one thing, something major has happened in corporate taxation in India. The corporate tax rate has come down to 25%, and for new manufacturing companies, it is only 17%. So the scope of profit shifting and base erosion in corporate tax has reduced significantly. And also the incentive for base erosion and profit shifting has also reduced significantly. If you presume that after 2 years there will be a minimum tax rate of 15% on all island jurisdictions, and in India it is 17%. In that case, India's corporate tax rate is pretty competitive that ways. And probably that's the reason why, what I'm guessing is the litigation, what I'm hearing from people is that, from practitioners, is that litigation is going down significantly. Litigation pertaining to base erosion and profit shifting, litigation pertaining to transfer pricing is getting down significantly. So what I'm guessing is externalization or corporate inversion will also go down significantly in coming years. But then again, tax rates move in cycles. They're very cyclic. Tax rates will go down sometime, then they'll go up sometime, then they'll go down sometime. So maybe in another 8 to 10 years, when tax rate is again at 30%, 40%, at that time, this may again become attractive. What we see nowadays is, what the chatter that we hear nowadays is that the headline tax rate on HNIs is about 42% in India. So many HNIs who do business in India still do business in India, but they maintain a tax residence in some other jurisdiction, in some foreign jurisdiction. There are some jurisdictions where receipt of interest or receipt of dividend is taxed at a very low rate. The allegation that flows around is that many HNIs are shifting to such jurisdictions because of that. So that is also a trend that we have been seeing. We have been hearing of late, very recently. I think that is all. Thank you.
Thank you very much, sir. I've noted remote working, data localization, and crypto.
Seema, if I may just ask one very quick question. Smarakji, I think you touched on many futuristic issues which keep on coming up, either by way of literature that domestic laws of other countries are trying to address, or it comes up when typically what we do for our living when clients ask this question. So if I may ask 3 things that you raised: crypto characterization, gig employees, taxability and PE, and profit attribution, the Twitter example.
Data localization.
Correct. So will you be able to share with us, what is the policy outlook? Will we see some of these policies taking shape as we are speaking, or will we see disputes and then policy coming after that?
Mukesh, you have put me in a tight place actually, because in my present day job, I work for the ministry. So please excuse me. I mean, please excuse me. I don't want to discuss this. Generally speaking, internationally, all countries are aware of this, and every country is grappling with it. And of course, I mean, every country. I mean, nowadays most countries are very proactive and some policy changes, because tax law itself is very dynamic, and most countries realize that. So all these changes keep happening all the time.
Sure. No, I didn't. My apologies if I put you in a very tight spot. I completely recognize your situation, but I appreciate you not answering this question. I just thought if there was any guidance that was available as to these are some of the futuristic policies that we should be looking out for. Thank you.
Thank you.
Yeah.
I think there's a question. No, it's just a thank you note. Yeah. All right. Does anyone have any quick questions before we leave? All right. Thank you very much, Mr. Swain. We really appreciate you taking out the time. Just for the benefit of everyone, while Mr. Swain has been saying his day job is very boring and blah, 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 his day job is probably the most interesting job. He handles all the policy matters relating to India's double tax treaties. His division also drives the FDI and bid policy for the Department of Revenue. He's also responsible for India, a big part of India's EPS and MAP program. Now, Mr. Swain, if that is not interesting, I don't know what is really.
No, madam. The thing is, any job, any job which is a day job is actually not interesting. That is what I was just saying. But yeah, I enjoy my day job also.
All right, sir. Thank you very much. We really appreciate you taking out the time. Many thanks.
Thank you for organizing it. Bye.
Thank you, Mukesh. Thank you, sir. Bye. Bye, everyone. I hope you all enjoyed it. Bye. We can now exit the session. Thank you.